Got some pretty big news from the major rental car company that all of us know, Hertz. They're announcing this morning it will cut 1/3 of its electric vehicle fleet over the year. CEO Stephen Scherr joins us right now to discuss the company's decision. Steve, well, first of all, welcome to Squawk on the Street.
Thank you, Jim. Good to be here.
Thank you.
Good to see you.
All right, Steve. I know you as one thing and one thing only. The man who just knows to tell the truth and nothing but the truth about financials from the days when you were at Goldman. This seems like a very positive for Hertz, for numbers, but definitely an asterisk for the adoption of EVs in this country.
Well, I think, look, we took a bold move and are making a strategic adjustment to our fleet to take 20,000 electric vehicles out of the fleet. It's really to respond to the reality, which is we're trying to bring supply in line with demand, and we're addressing a cost issue that happens to be related to the EVs in the context of damage and damage costs. That's what it is. But in the end, this is about the numbers. It's about the financial performance and the operational depreciation, but equally the operational integrity of the business. And so we'll put EBITDA on in the next 2 years that will equal what the charge was, and we'll increase cash flow by about $250 to $300 million. So this is about, it's not about the broader issue of EVs for the company. It's about financial performance and operational integrity. And adjusting ourselves in the way in which I think the business needs to be run.
No, I think that one of the things that you were spot on was that, look, Tesla's the largest in the country, and you wanted your fleet to reflect Tesla. At the same time, unlike what Kathy Wood said earlier, you were explaining that there is depreciation. These do not go up in value after you buy them.
No, I mean, look, the reality here is that we're experiencing the consequence of a material price decline in Teslas, but in EVs more generally. So at the beginning of this year, when Tesla took down the price of their cars, residual price falls, depreciation goes up. That's obviously a cost to the business. We need to face that reality. Tesla did what they did for reasons that are presumably good for their company, but we just need to adjust to the reality of what the cost input is of this car. And so we've made this move to really put ourselves back, on track. It's interesting to note, Jim, that demand for our product is real and is sustaining. What we put in our 8K as an indication of what happened in the fourth quarter, demand was there. Revenue was in line with what expectations were on a seasonal basis. The issue I'm addressing is one of our cost base and the influence that EVs have had on that cost. And there are certain circumstances like price decline, like residual decline and depreciation that's out of our control, but you need to react to it, and we're reacting to it.
So that's interesting. It's different from demand or behavioral friction when someone comes to the counter, because originally the thinking was this will be a nice way for people to experiment. Did that happen, or did it not?
It did happen, and it is happening. It's just not happening at a level of demand that justifies us maintaining a fleet of this size at this moment in time. Carl, the one thing I would say is that at some point, the reality of EVs and Teslas being the best-selling car will at some point render them the best rental car. It's not yet. So we may have been ahead of ourselves in the context of how quickly that will happen, but that will happen. And I think, in the end, we're in the business of giving consumers choice. We're including in that choice electric vehicles. And there is a significant component of our customer set that are still paying us a premium for these. It's not at the level of demand that we anticipated. And I think a smart company is one that's agile, makes an adjustment, takes away the distraction, financial and operational, and moves on.
I do think, apropos of what Carl's saying, there must be something wrong with EVs in the sense that maybe they're hard to repair. Maybe people don't necessarily know how to drive. Maybe there are accidents because or they wreck the cars because they don't know how to do it.
Well, look, we do two things when we rent you a car. A, we make sure you can pay for it, and B, we presume you can drive it. And we ask for your license on the latter. The reality on EVs is that there are millions of Americans, in fact, millions of consumers around the world who are knowledgeable, experienced in EVs, and they ride them well. There are those that experiment, and their knowledge of how to drive this car, which is a little different than a combustion engine car, may be part of the issue. I would point out that our joint venture and the demand we have with Uber is proving very successful and has grown, as I talked about on our third quarter call, by as much as 50%. and they are taking up even part EV and ICE vehicle. And when we talk about how much time this strategy will take to play out, bear in mind a lot of cities in this country are going to require rideshare companies like Uber, like Lyft, to be all electric by 2030. So we may be a little early, but the early growth with them is working well, and we will have ample supply to continue to feed that business.
There is some misinterpretation, maybe because people are not as good about what depreciation means as you are. This, to me, is something, when I remember that you had a problem with this last quarter, you're dealing with the problem. Cash flow is going to go up, not down.
That's right.
This is going to influence the stock positively, not negatively.
Well, I would hope so. But as you and I have talked about many times, it's not for me to predict where the stock is going to go. What I want to do is produce financial results for our shareholders that are worthy of a higher valuation than where the company is. And I think addressing the cost element in the context of a healthy demand layer is what we're doing. It's what this adjustment in fleet is about. And I think it will prove to be a net positive for the company as we go forward.
Can I get you just a little more broadly? We just got CPI. We were talking about airfares. Sure. How is overall demand holding up? Was corporate continuing its comeback or not?
You know, we continue to see demand rather strong. We saw it through the holiday. We're seeing it in the opening of January. And it's across the board. It's in leisure. It remains in corporate. Don't forget, we have a big inbound business. So this is where Europeans, Asians, South Americans travel to the U.S. and rent from us. The airlines are continuing to show strong, particularly those with international routes. And again, we're growing up different business lines in the context of rideshare, which will continue to grow, you know, as we feed that business.
I have to believe, Stephen, that one of the things people don't get about business is if you're working from home and you want to go see a client, the best way to do it is to rent a car. We don't want a situation where you don't ever go see clients again just because you're working from home.
No, I mean, look, the reality of the business world is one in which there's no substitute for personal interaction. And we're seeing that gradually come back in the context of business travel. Bear in mind, on the rental car side, you know, we are the tail on this, meaning the decision to go on a business trip or take your family on a vacation is not determined on whether the rental car is $5 higher or lower. It's determined largely on the airfare and the hotel. And so, you know, we've seen a relatively stable price environment, a little softer relative to where it was in COVID, but sustainable and well above pre-COVID levels. And there's no particular incentive to see price soften across the industry because it doesn't drive demand to the industry writ large. And market share has been relatively stable among the majors in rental car, you know, for the last year or more.